Hey traders, welcome to lesson 2 of the SMC course series. In this video, I'll be diving into the main element of this entire strategy, which is supply and demand. So even if you think you know supply and demand already, I highly advise you watch this video anyway, because supply and demand is probably the most subjective part of SMC. So in this video, I'm going to give you a way that we can all look at it the same way. So let's start by looking at what supply and demand actually is, right? So we're not here for an economic or financial degree. So I just look at supply and demand in a very simple way. So let's say you wake up tomorrow morning and you open your front door and someone has left a bunch of crates of watermelons. You have 100 watermelons at your front door, right? What you have is a supply of watermelons. Now, obviously, you don't need 100 watermelons. You're not going to eat that all. So the best thing to do would be to sell them. And let's say it turns out that all those watermelons that turned up at your doorstep were the entire town's supply of watermelons. So you're the only one that has the supply of watermelon. So you're going to sell them and you can put whatever price you want on it because you're the one that controls the supply. Now, let's say 1 week later, you've given away all your watermelons, but people start turning up at your door again and they're like, hey, do you have more watermelons? Because we want to buy some more. What you have now is demand. So people are coming to you demanding watermelons. However, what you don't have is supply. So to get back your supply, you need to buy watermelons. And that's pretty much how every single economy and anything money related works. You buy to get a supply of something. Once you have the supply, you sell it. After you sell it, there's going to be a demand for that thing because it's no longer available. And this cycle just continues. And this is exactly why we're interested in supply and demand when it comes to trading. Because what you see is that price is constantly moving in a cycle and pretty much bounces between supply and demand. So we use this to help us identify good POIs in the market for us to sell from and to buy from. So now that we know what supply and demand is and why we use it, we need to look at how we can actually start spotting it on the charts. So in order to keep things mechanical and objective, we just want to define all the conditions that we are looking for. So for me, let's start with supply. So we know that supply is when you are selling something, but how do we spot this on the chart? So what I look for is impulsive moves in price. Now, in order to keep this objective, we need to define what impulsive moves are. And for me, that is simply a move or a selling move that has created a gap. So you may know this as a fair value gap or an imbalance, but for me, like I said, we're not here for a financial degree. So if you ask me what a fair value gap is, I wouldn't be able to tell you what those words actually mean, and I'm sure most of you wouldn't be able to either. So for me, I like to just keep things simple as they are. So all I'm looking for is literally a gap, and I have some examples here. So let's dive into these. I'll just make it bigger here. What we have here is a selling candle, and we can see the previous candle closed over here. So you look at the entire candlestick, wicks and body included. Now the next candle, the high of the candle, closed over here. So this is our selling candle, and with the candle before and the candle after, what we have created is a gap, and that's all it is. So this is how I define impulsive moves. And you can see that we have here as well another gap. So this is again another impulsive move. And this continues. So for me, this entire move is showing me signs of impulsive selling. So how does this link to identifying supply? So once you have identified the first impulsive move, so this gap, what I look for is the candle before that. So remember we talked about how supply and demand is just a cycle. So in order to have a supply, you're not going to wake up and find your supply at your doorstep in real life. You're going to have to buy your supply. So that's the same theory we look at when we are marking our supply and demand zones. In order to identify supply, you want to see a buying move before the supply is sold. So in this case, you can see a buying candle, so price was bought before the impulsive selling, and therefore I would draw this as my supply zone. So we'll go into more examples on the chart in a bit, but I just want to explain the theory here. Now let's go over a demand example. So in the case of demand, it's the same thing. You first want to start by identifying an impulsive move. So if we look here, this was the highest point of the first candle. And then over here, the candle only reached this low over here. So what we created was an impulsive buying move. You can see here that there is no gap between these candles, right? So therefore it wasn't impulsive buying. But we did have it over here, and that is a smaller impulsive move. It doesn't matter how big or small the gap is. Obviously, if it's bigger, it means it's more impulsive, but as long as you just see any level of impulsive move, it's good. In order to have a demand for something, you first need to sell everything that is available. Because if something is easily available, there's not going to be a demand for it. If everyone had a Rolex, no one would care to buy a Rolex because the importance or, the specialty of having a Rolex is no longer there, right? So first something needs to be sold and there needs to be a limited supply of it, and that is what's going to create demand for that item. So that means then people will want to buy it more. So if we look at the last selling move before the impulsive buying, we have a demand over here. Now, how do we actually draw our supply and demand zones? You want to draw the entire candle. In this case, we took the entire last buying candle before the impulsive selling move. However, in this case, you can see that the buying candle went lower than what would have been our demand zone. The reason I still draw my zone all the way to the bottom of the impulsive buying candle is because if you just think of it, if you just ignore the colors of the candlesticks, this move from the previous candle to the current candle that we're looking at, it is still part of the selling move. That's why I take both candles in consideration when I'm drawing my zone. And you can see that same thing happens over here. So demand is literally whenever you have that impulsive buying, look again, you have a sell move right here. So you would draw that demand over there. And like I said, this one, it didn't have impulsive buying. So there was no demand here. We had demand over here, and then price went up. So that is it. That is the basics of supply and demand theory. And these are obviously taken from screenshots of the live charts. So what you can do is apply this theory and go look for more supply and demand zones on the charts, any chart, any pair that you prefer. And you can send me your examples if you like, and I can tell you if you mark them out right or wrong. But yeah, hope you found this video easy to understand. Let me know if you have any questions. You can ask me in the server, and I'll see you in the next lesson.